Rust Belt Capital is an elite Ohio-based private equity firm with a specialization in long-term, high-cash flow multifamily investments. If you're looking for long-term recurring income, you should check out Rust Belt Capital. From their approach to managing risk, to the locations they invest, the product quality they provide, this firm is serious about what they do, which is why the owners of Rust Belt Capital invest their money in every deal they take on. Review their case studies by visiting rustbeltcapital.com. That's rustbeltcapital.com. Once again, rustbeltcapital.com, or email investor@rustbeltcapital.com.
When there's 2/3 of these properties in the United States are still owned and operated by unsophisticated operators, just at least at my level, what I'm focused on is consolidation and aggregating and deploying our automated model that does create a lot of value and efficiency on those properties.
Hello, left fielders. Welcome to the Passive Investing from Left Field podcast. Our community is focused on networking and education to help people invest passively and think differently. Let's go.
Hi, this is Russell Gray, co-host of the Real Estate Guys radio show, and you're listening to the Passive Investing from Left Field podcast.
I'm really excited today to have Cliff Minsley with us. He is the partner and co-founder of 10 Federal Companies. He is responsible for leading corporate strategy, capital raising, finance, technology, and business development within 10 Federal. He's been active in real estate for nearly 20 years. He's been directly involved in over $700 million of real estate development and acquisitions within the multifamily and self-storage sector. So, Cliff, welcome to the Passive Investing from Left Field podcast.
Thank you so much for having me.
Really happy to have you here. And the way we start out is, we'd like to hear your journey. How do you get into real estate? Looks like you were in multifamily. Now you're in self-storage. You're doing some really cool things in that sector. So if you can just kind of give us the story, how you got to where you are today.
Yeah, for sure. So from Chapel Hill, North Carolina, originally. Grew up with my brother and my parents there. My parents weren't involved in business, but we kind of were a family that loved talking about business and buying real estate and trading real estate, things like that. And as I got older, my brother's a little bit older than I am. And he was the first one off to school and the first one out of school, and began working with a real estate firm out in Durham, and had a lot of success working with the gentleman that started that firm. I later joined them when I was at school at UNC. I'd go to school in the mornings and then go work for them in the afternoon, and just loved it, and started the career in that way. It was great working with my brother at that time, and with the gentleman that started that firm, and ended up building quite a large company. Started in the living room. By the time we hit the 2008 mark, which is a pivotal year, as everybody knows, we had grown the firm from the living room to the 11th largest multifamily developer in the country by the metric of how many units were started. But with that and the use of debt, we faced a lot of headwinds in 2008, 9, and 10. Thankfully, through a lot of determination and hard work, we were able to navigate that at the previous firm. But on the tail end of that, we also had made the decision that our lens for business was slightly different from that founder, and we decided to hang our own shingle. So we started our firm 10 Federal in 2010. And when we started in 2010, we were a multifamily shop. We had originally started as developers, but going through the GFC, we had a different risk profile tolerance coming out of that, and so did some of the investors that followed us. And so we were essentially buying multifamily deals, and I'm not sure how many of your listeners remember that time or are familiar with what lending was like in 2008, 9, 10, but there really wasn't much of it. And so we got a PhD on HUD financing. So we were buying multifamily deals that were financed with HUD. And we put together a sizable portfolio over the next 5 years, which, that was a tremendous amount of effort and work. And we essentially had gotten the lights on, so to speak, with the business. But we were interested in diversifying into other asset classes. And so lo and behold, we came across self-storage, which was interesting because I would say it was very similar to multifamily. Essentially, you're renting boxes, two different types of boxes, but boxes nonetheless. And what became immediately apparent to us was that storage could be a tremendous opportunity. it was a massive industry. There are many, many storage facilities in the United States. For rough numbers, there's about 3 times the number of self-storage properties in the United States than there are McDonald's. And what also became apparent to us was that the industry seemed to be fragmented, and it seemed to be overwhelmingly controlled by unsophisticated operators. And so, seeing the confluence of those two things, we started to get excited about the space and thought there might be a lot of opportunity in it. So we started deploying capital with some of our same investors that helped us through the multifamily acquisitions. And as we became accustomed to operating self-storage facilities, we were sort of scratching our heads as to why there was a person that was physically at these locations managing them. We felt like that wasn't necessary, especially when we observed other businesses or things that provide services to people, such as like ATMs and car washes. Those are the 2 examples I always use. One's giving you money and the other one has a million moving parts, but neither one has a human being operating it on a day-to-day basis necessarily. And so we decided that we were going to give it a go. Our original hypothesis was that if we eliminated the on-site manager, we could make a material improvement to net operating income by eliminating OPEX, mostly in the form of payroll, which was one of the largest, if not the largest, OPEX line item in a chart of accounts for a storage facility. And seems simple enough. Fast forward 8 years from that day, and there is a lot that goes into managing properties in an automated fashion. I think whether it be storage or any other type of property, there are a lot of tripwires that you don't see when you start walking through the woods. But we were, I think, innovative, and we were curious, and we've always worked to feed those 2 desires. And I'm proud of what we've done. If you fast forward today, we've raised 4 funds. We've exited 2 and have done very well in those exits. We're continuing to aggregate a portfolio. Folks that are familiar with storage might know that there's kind of a consolidation that's occurring as more Wall Street and sophisticated money is intending to invest in storage. You're seeing a consolidation. So the unsophisticated operators are selling to more sophisticated groups. And just like many industries, ours is being consolidated, albeit there's a ways to go. It's still 2/3 of the properties in our country are owned by unsophisticated operators. And so we're part of that consolidation. We've got a lot of different technologies that we've developed in-house that are proprietary. Some are some we've developed and then have moved on to things that have become available off the shelf, which is nice. A good example would be like we used to have a rent algorithm that we wrote, and now there's a third-party algorithm that's available that has a larger data set. And so for that reason, we think that might be a better product, and it appears that might be something that is coming to be true. It's an exciting space. It's been a great learning experience, and we're really bullish on storage for the long term.
Well, that's a great introduction. Thank you for that. And I want to take a detour before we dive into self-storage, because that is the main thing I want to talk about. But you mentioned that you got into self-storage because you noticed 2 things. It was fragmented and unsophisticated owners. So now that, and self-storage is still like that, right? You said there's still a big chunk of that. But are there other asset classes that you're thinking of eventually, maybe sometime transitioning to, that have those same categories? Because I think that's a great opportunity, right? You're looking for something that is fragmented, unsophisticated owners. Are there other asset classes that are like that?
Yeah, I'm not an expert in all the various asset classes that are out there, but I observe and I listen, and I do think that there are opportunities in other asset classes. I think maybe potentially within various asset classes, like if you think of maybe retail, I think there's interesting opportunities in neighborhood retail. That retail seems attractive to me in that it hasn't been disrupted as badly as like the larger power centers and the ones that you would see like with a Target, that they've been disrupted by the Amazon effect, Whereas you go into like a well-to-do neighborhood, and folks are just never going to give up their, the nail salon around the corner and the bakery. And I think those are insulated and providing services that will always be, there will always be a demand. But I don't know that, and I use Wall Street as a proxy for sophisticated money. But I don't know that Wall Street has gone and wrestled all the neighborhood retail centers to the ground and consolidated that industry. There are others that sort of come to mind, but we need to focus on what we're good at and where we've got competitive advantages. So we're predominantly focused on storage at the moment.
Yeah, and that makes complete sense. It's just when you said it, the way you said it, I was like, man, that is what you're looking for in other asset classes. And I like to chase the shiny object. So that's why I brought that up. But let's dig into self-storage. So you said you're on your fourth fund, and the fourth fund has a unique debt strategy. So I assume the first three had a different debt strategy. So can you talk about the debt on the first three compared to what you're doing on the fourth?
Sure. Yeah. So, when we launched our first fund in 2017, and through the raise of Fund 1 and then into raise Fund 2, debt was very inexpensive. And learning our lessons, though, from using high leverage, which I'd consider like 75, 80% against a purchase price or total project cost, which is where we used to lever back prior to the GFC. We were deploying capital and coupling it with about 60 to 65% leverage, which we felt was very modest at that time. And debt was extremely inexpensive. I remember we got a portfolio loan on our first fund after we were taking the assets down with individual community bank and small regional bank loans. And then once we had the portfolio seeded for Fund 1, we did a portfolio refinance and essentially traded out all the lenders for a single debt instrument. And our interest rate on that loan was 1.81%. And, so that allowed us at a very early stage in the fund life cycle to pay our preferred return current and surpass it, which was phenomenal. And then, my brother and I are students of business. We're also students of economics. And as we were raising our third fund and COVID was unfolding, we were alarmed at the amount of stimulus money that was injected into the system, and recognizing that there were supply chain issues and just this sheer amount of cash that just the United States government injected into the system, we became concerned that inflation was going to be an issue. And funny enough, we remember back to making predictions about inflation in 2008, if folks remember the TARP funds, which was, I think, in total $1.5 trillion. So it was a fraction of what was injected into the system from COVID. But back then we were concerned about inflation, and that was part of our thesis of buying real estate and financing it with fixed coterminous debt, which was our original business plan in the multifamily side of things. It was really an inflation hedge tied to income producing properties, which history shows is a winning strategy. But if you fast forward to COVID, we were starting to look at the history books like, okay, well, what happens when interest rates go up? And if you look back to the late 70s and Volcker and, who was the Fed chair at the time, the lever that we have to combat inflation is to raise interest rates and cool off the economy. And so we made a prediction that we were going to be entering a time of interest rate increases, and there would be volatility in the interest rate markets. And for those reasons, we made a decision for our fourth fund. We had already raised our third fund and deployed that capital. And Fund 3 was a $45 million equity fund, and it's paired up with about $35 to $40 million of debt. So it's a little less than 50% levered. We had made a decision that we were going to avoid using debt on our fourth fund. And it's not because we don't intend to use leverage. It's just that we felt, first of all, the interest rates you're paying for debt were not accretive. The debt cost more than our equity preferred return at the time of launch. And we also felt that there would be a lot of volatility. We didn't want to, I think it's a bad strategy to time a market or try to time a market. So by raising, in our fourth fund's $100 million, we're oversubscribed on our $100 million raise. We've got a closing coming up, an equity closing coming up on April 1st. And then we'll probably have one more equity closing where we'll invite investors in to make commitments and to fund. But it's $100 million, and we were going to deploy that and have just buying assets in cash. We've got roughly $10 million of debt. We've got about $50 million of equity deployed. And the debt, there's a 4% interest rate loan we didn't want to pay off, and the other two were bridge financing. We intend to pay those off at the end of the capital raise period. But we believe that essentially what it provides us is an embedded option. If interest rates remain high, then we can continue to execute on our business plan, which we feel creates value through good operations and technology and all the value adds there. But if debt does become more inexpensive, if rates start to drop, then it provides us with an interesting opportunity where we can go and lever against the existing portfolio of real estate, which would then allow us to deploy more capital and buy more assets. And whether or not we buy more assets or we do like a cash out refinance and return equity to investors, that again is a timing issue in our view. It's whenever interest rates come down. If we're really past the capital deployment timeline, we'll probably do a cash out refinance and return cash to investors. And so then conceivably we would have a higher cash on cash return, and we can wait for an opportune time to exit the portfolio. Or we might be able to leverage the unencumbered portfolio and grow it by leveraging some less expensive debt. But regardless of which way interest rates go, we don't have a gun to our heads, and we're not forced to do one thing or the other. We've got, like I said, an embedded option play. So I'm pleased that we had made that prediction, and things have come to pass as they have.
Yeah, I think no debt is a really interesting strategy. I'd like to know, it gives you options, which I think is crucial, especially, as we see what's happening in some of the multifamily, bridge debt situations. But what does it do having no debt now, or very little debt, as you said? What does that do to the investor return? So you said you're oversubscribed, so people must be pretty fired up about it. But compared to some of the other, operators out there, if they have more debt, the returns, or the projected returns at least, should be higher. So can you talk about how that interacts, the debt with the returns to investors?
Sure. That's a great question. Let me just preface by saying that there are no guarantees on any investment, but we prefer to under-promise and over-deliver. If we can do that, then that's always seems to be a winning combination than the inverse. But it is true that it's a bit harder to produce the same returns not using leverage. What I do think we can do and do well is through the tremendous amount of work and effort and success we've had in creating these technologies and being innovative and really thinking downrange. I think we are able to create potentially more return than some of our peers that don't implement the technologies that we implement, that aren't as efficient, that aren't thinking about the things relentlessly that we think about. So I think that even with the absence of debt, we can deliver a saleable return to our investors that's attractive. And if you take a step beyond that, if you're going to compare us apples to apples with other sponsors who are using debt, sure, maybe they can use debt as a crutch to meet or exceed our returns, but I'd hope that a sophisticated investor recognizes the risk profile of the investment with no debt. At the end of the day, if we are hit with another black swan event, or if the Fed lowers interest rates as they've indicated they are going to do this year, only for the housing market to go bananas again and immediately inflation comes roaring back, well, they're going to do the same thing. They're going to raise interest rates. And if you've taken on debt and you're not conservative about it, whereas we really have limited our downside by the absence of debt, you can quickly be back into a lot of distress and trouble. And again, I want to just reiterate that it's not that we do not intend to use debt on the current fund. We just want to use it under our own, at our leisure and at our convenience, and when we believe it's the right time to strike. And if we do that, then I do think that we would be on potentially at the upper echelon of returns because we are using debt and we're able to lever our returns.
Yeah, I mean, it makes sense because investors right now are looking for safety, low risk, and the less debt you put on it, the more you're in that category. But as you said, just because you're not doing debt now doesn't mean you can't change the thesis if economic conditions change. So that's super interesting. But now I really want to dive into the technology, the automation, because I think that's super interesting. Now, you mentioned that you don't have staff at the locations, which is amazing, right? But let's talk about that. I want to hear all about the automations, the technology. What are you guys doing that other people aren't? What are you guys doing that other people are? But all this automation, what are you doing and how does it, boost returns?
Yeah, I could go on and on about this. Trying to think about where even to start. I think, prior to COVID, one thing that was shocking to me was that, and this is true of all the REITs, you couldn't go online and select a unit. You could reserve a unit, but you couldn't go on, select a unit, and sign your lease and just go directly to the property and move into a unit. So that's something that was seemingly novel prior to COVID, which I think is pretty much the norm, at least for the sophisticated operators now post-COVID. So when we were hit with COVID, for example, Black Swan event, it was business as usual for us. All the stores remained open. It was really no disruption to us, except for here at the corporate office. And I just want to be clear, we do have people that visit the properties. We have a maintenance tech that visits a number of properties. Each property gets visited on a weekly basis. And, the things that we do that are automated and the things we've had to figure out. I mean, like if you go to one of our properties, you're going to see an office. It's going to be clear where it's designated. You're going to go in. We have a kiosk, which in my view, personally, I mean, I'm a little bit younger. So if I'm like at the grocery store, I'm going through the kiosk line because I just want to get in and out. But to me, like our kiosk in the office is sort of a psychological landing pad. But what we want to do is through automation and through technology, we want a core principle of ours is deliver product into the hands of our customers in a frictionless manner. And so we are relentless about every time that we have a customer interaction, especially if it's in the sale of the product, how can we make it faster? How can we make it simpler for someone to use? Like an example is if you arrive at one of our properties and you scan a QR code, and we just released this through, we have a spin-off company called Da Vinci Lock, but we just released a product feature called Tenant Connect, which is included in the Da Vinci suite of services. But you just scan a QR code and it can populate your information. You can move in under 30 seconds. It's something that I think is unique to the industry. But, it used to be not long ago, download an app. Well, I don't know about you, but I can't find apps on my phone because all I have is apps on my phone. So it's trying to stay ahead of the curve there and think about things in that sort of respect. To save money on the operations side, for example, we do video walkthroughs and we have drones on the properties so that we own properties in Houston and in Georgia. And again, I mentioned we're here in Raleigh. Well, our managers and our regional managers, they're able to go and check through automated and remote technologies to be able to audit things at the properties. Like they can fly a drone over some of our properties and be able to audit whether or not the lights are coming on at night or if there are leaves in the drive aisles. Our maintenance techs will walk with our regional managers on essentially like FaceTime, but we're even working on exploring maybe potentially using Google Glass the new Apple Vision Pro about how could we maybe improve that? Because if they don't have to get on a Delta, or a regional manager doesn't have to get on a Delta jet, it saves $1,000 for a property visit, which gets passed onto the property. So we're trying to do everything in every corner to make it efficient to manage the properties in an automated manner. And then also just from an investment standpoint, we've created a lot of different technologies that we use on the investment side of the house to try to make business decisions for acquisitions and things of that nature. So it doesn't span only to the customer touch point. It's kind of in everything that we do. It's in our DNA.
And how do customers react to this? So they can you show up to the site, you pull out your phone, scan the QR code, and then you're good to go. You have all the information, and then I assume that the lock, you can open the lock maybe with your phone. I think it would be great, but I'm sure there's also some people who aren't so excited about technology might fumble around and, hey, I need some help. Where's the person that's going to help me? So how do customers react?
Yeah. Well, this is something that I've learned through our executive team that we've hired, and I think a huge proponent of this now is we really try to do our best to listen to the customers. In my, I don't know, I think to a fault sometimes I assumed I could answer everything for the customer and I knew what they needed without them telling me, and that's really just not the case. And people are all too willing to provide feedback. So like when we have folks that move out, we survey them. When we have people that move in, we survey them. We try to listen to our customers about at what part of the process do they find friction. Or if they're calling into our call center, how is our AI bot and IVRs responding to tenants, and do we have high satisfaction there? And what do we need to go in and tweak and dial? And we're constantly tinkering to try to optimize customer satisfaction. I'm pleased to say that, and I think most would agree with this, that as time kind of rolls along and technology becomes even more intertwined with the daily life of individuals, I think that technology is becoming more the norm than something that, it's like, this is a cool, bell or whistle we're tacking on. It's really something to make the customer experience better. And I think the general populace is starting to embrace it more. And even, like folks like my parents are using tech that I never thought they could ever get past. I remember trying to teach my parents like what a text message was and how you use that, and they've come light years from that. So it's I would generally say that I think tenancy and tenants and the general populace are doing their part to embrace technology, which makes our jobs better too.
Investing in syndications can be a daunting task. Wiring a large sum of your hard-earned money to someone you talk to on the phone for 30 minutes can certainly be scary. How can you be confident in what you're doing? Steve Sue, one of the founders of LFI, just published a book called Avoiding Rookie Errors as a Left Field Investor. 20 lessons learned from 14 years of investing in private syndications. This is by far the best book I've read on syndication investing. It's an easy-to-read book, chock full of great advice from Steve's experience as a passive investor. It is a must-read. Whether you're a first-time passive investor or a veteran, go to www.leftfieldinvestors.com/books and click on the link to Avoiding Rookie Errors as a Left Field Investor. If you are a passive investor, you got to read this book. Have a deal in mind and a group of investors ready to go? Use TribeVest to pool your capital together through a multi-member LLC. TribeVest has streamlined the group investment process, making it easy, quick, and safe to do business with others. Start a tribe and invite your partners to join. Then you can use the platform to collaborate with your partners, pool capital, and manage your joint investments. I'm in 12 tribes myself. It is a great way to learn from others, spread risk, and get into deals at lower minimums. Go to tribevest.com to get started today. Now, my understanding is for most self-storage, it's, people are choosing it based on proximity to where they are, right? So I am going to choose one of the two self-storage that's within a half mile of my house is where I would choose the self-storage. Now, I don't know which one of them has which technology. I'm just going to show up at one. Maybe I look at the prices and compare. So is this more, all this automation, is this more of a cost saving measure, or is it also a marketing strategy where you say, hey, we're super easy and you can come anytime and just sign up, you don't need to talk to a person, and off you go? So can you kind of talk about where it fits in your marketing strategies?
Yeah, that's a good question. We use all the normal outlets you might expect, like SEO and things of that nature, and the lead aggregators. And again, this moves so dynamically. My operations teams could probably answer this better than I can. But yeah, we stay abreast of what are the technologies and the services that are offered that have a positive impact on SEO. Most storage is consumed online. That's generally how people are finding where you're located, and they do price comparison and peer reviews. We're hyper focused on peer reviews. So I think the best answer to that question is we focus on what drives SEO. What are the things that are amenitized for a tenant, that are tech enabled, that drive SEO, and then how can we ensure that our experience not having a manager is superior to the legacy models of having an on-site manager, which has a direct impact on peer reviews and online reviews. And I don't know like what you do, but I am not a big shopper. I don't like going to retail stores unless I'm buying a coffee. That's about all I like buying at a retail store. Everything else for me comes from Amazon. And it used to be price that was the lead indicator. Now I'm looking at peer reviews and what product has the most reviews and who's saying it works the best. And then that becomes the number one item in my decision matrix, and then price thereafter. And so that's, I think, the same sentiment we have about storage and how we can use tech to be a marketing element.
Yeah. And so also the added value, right, of self-storage often is you take, part of it is you take an empty part of the lot and you put some new units on it. But also people talk about selling locks or, the U-Haul part of it, or selling them tape and boxes, all that, small stuff that adds up. If you don't have people there, do you do that? Or are there other ways that obviously you're adding value through the technology. So I'm not arguing against automation. I love that part of it. But I'm just trying to think, like, comparing to the typical self-storage place, where do you get your value add? Because it's, you're doing the reviews and things, and that's a great way to get people in the door. But how do you increase the NOI so you increase the value of the property?
Yeah, I mean, this is a good question. It's one that I get asked quite a bit. We are not focused on the, what's the airline, like the Allegiant airline where you charge for water and you charge for this and you charge for that. That is not what our model focuses on. We really try to go for the big swings in value. We are looking for the obscure market with the obscure acquisition opportunity where we can raise rental rates 50, 75, 100% in some instances, and we can have a profound impact on value for that reason. I'm not saying that there isn't value in thinking about lock sales and bubble wrap and potentially partnering with U-Haul, but it is not our core focus. When there's 2/3 of the properties in the United States are still owned and operated by unsophisticated operators, just at least at my level, what I'm focused on is consolidation and aggregating and deploying our automated model that does create a lot of value and efficiency on those properties. I love, the Japanese mindset of always take something and then make it 10% better, then make it 5% better, then make it 2% better, and be relentless and always make something better. And we will get there eventually. But currently, there's too much low-hanging fruit in the big value swings. And at least in my personal opinion, and I won't speak for everybody in the entire organization, but there's too much to keep us preoccupied on hunting the big meals.
That makes sense to me. So when we're talking about limited partner investors, right, and they want to invest in a self-storage facility, they can analyze the individual facility. They might have some metrics that they look at. They're not going to underwrite it like you would if you're buying it, but they're going to do it as a passive investor would. So you're in a fund. So how does an LP kind of analyze and determine, okay, I want to make sure I understand the deal. I want to make sure I understand what kind of properties are going to be in the fund. It also probably depends on when you invest and when you don't. But what kind of metrics should LPs be looking about and how do they analyze a self-storage fund to determine that, yes, I want to invest in this fund?
That's a good question. I think putting my investor hat on, what I'm looking at, obviously, are they familiar with the business? Do I agree with what they're saying? I'm going on the assumption that you've made a decision that you want to explore investing in the self-storage realm. Then I'm looking at track record. I'm looking at previous performance, and I'm really trying to understand what their model is. Like 10 Federal's current model for our value add funds is not to go buy a deal from like a Public Storage or a 3 or 5 story deal in downtown Buckhead or something like that in Atlanta. Where we create a lot of value, and what's unique to us is we're able to go into the markets that are around the major MSAs, but deploy capital in the markets that are currently controlled by the unsophisticated operators. You've got people that live in those burbs that they have iPhones, they've got Androids, they've got technology, they're accustomed to it. They're looking for a simple, secure, safe, easy interaction. And if I'm an investor, I'm making a decision, do I want to go invest in something that's, one of these core assets and potentially take a little bit of a smaller return, or do I want to invest in like a 10 Federal or one of their peers where, these guys they've got a track record, they're confident in what they're doing, their story makes sense to me, and then I'm trying to assess the downside risk, and I think the story of no leverage is a good story. And I would observe what are the returns that are being offered, what are the returns that have been achieved in the past. Is it a blind pool of assets or is it semi-blind? Currently, we're offering a semi-blind pool because we've bought some of the assets in Fund 4, but not all of them. Or are they finishing it up, and I pretty much can go see what the storage assets are, and I can go visit a store. I can physically drive out and visit one of the stores and see what they're selling to the public. Those are some of the things I think I'd be looking at.
Excellent. Well, thank you for that. And the last question I always ask is, what's a podcast that you like to listen to?
Yeah, so currently I am hooked on the All In podcast with David Sachs and David Friedberg and Chamath Palihapitiya and Jason Cal. I can't say Jason's last name, but I really love that podcast. I think those guys are sharp, and it's something that I really enjoy listening to.
Excellent. And then the last thing, if listeners want to learn more about you or 10 Federal, what's the best way they can connect with you?
Yeah, so they can go to 10federal.com, and we've got an investors link. And, if they reach out to you, that you can certainly just send them my way. But the investor link on our portal is just, it's just a quick little form. They just send it out, and we'll see it on our end that there's interest in somebody from our organization. We'll reach out to them.
Excellent. Well, this has been fascinating. Thank you so much for coming on the show.
Thank you so much for your time. I appreciate it.
Left Field Investors is a community dedicated to limited partner investors who are interested in building wealth through real estate investing. The community is focused on education, networking, and engagement with quality operators and partners. We provide tools, webinars, and a forum where members can discuss everything related to real estate investing, including deals, operators, investment strategies, and much more. Coming soon, we're adding a new tool, sponsor reviews. This will be a place where our members can rate and review operating partners to further help each other in our investment journeys. Check us out at leftfieldinvestors.com. Visor provides investors with a secure platform that displays a comprehensive view of all of their holdings on a single, holistic dashboard. From real estate syndications to private equity, crypto to traditional investments, with AI-driven, unbiased, honest insights to maximize return. Visor is your one place to rule them all. Automating performance tracking, projecting future cash flow, analyzing all your financial documents, and much more in one powerful solution, making it easy to follow the money. Sign up for a free 30-day trial now at Visor.co. That was a fun conversation with Cliff. I love the tech and the automation stuff in any of these asset classes. But, he started out, he's talking about 2008 and how they made it through 2008 in the GFC. And took me a couple of minutes. GFC, I was going to ask him what that was. Oh, the Great Financial Crisis. So if you didn't catch that, he was abbreviating that. But it's interesting because he was a multifamily guy, and they built this huge company and then had this huge financial crisis, and they were able to get through it. And it's not in the asset class that he's in now, but still what we're looking for, right, is people who've made it through cycles, and he's made it through that cycle. And it looks like it sounded like the returns on the current financial difficulties we're having with his limited debt that he's probably on his way to making it through that one as well. And he did compare self-storage to multifamily. So it was a natural kind of transition because it's just a box, right? One has people in it, one has stuff in it. So, he kind of talked about how that made the transition easier. And then automation, I just am really interested in that, as I said, and he uses automation as one thing. It eliminates payroll as a major expense. So when you're talking about added value, it is added value to reduce expenses. Now, I'm sure the build out of that technology probably cost a lot, but you can spread that over all of your properties and over a lot of different units. And then, frictionless customer interaction is something that you can tell that just incrementally they are constantly trying to improve the automation, so to make the experience better for customers. And although I guess the reviews are the thing, right? Because I wasn't sure if people are, I don't know that I would think, oh, they're automation, so that's why I'm going to that unit. But when you're comparing it to one right next door and you look at the reviews, you think, okay, I'm going to go to this place rather than the other one because it has better reviews. And then you find out about all of the automation, which I think is pretty awesome. And then very interesting, right? No debt. And when you hear that, you think, okay, what about the returns? Well, right now, I'm okay with lower returns if it's less risky. And you have options. If you go with no debt, you can always get debt later, as he talked about. And debt, what it does is it increases risk for sure, and also potentially returns. So if you're starting out with no debt, and that's really interesting, because then you can think about, well, if interest rates do go down, maybe I can get some debt, a little bit of debt. And each time you put some debt on those properties, you're going to increase returns, but in a safe way, where as if you do it up front, you're kind of locked in. But if you do it on the back end, you have choices. And so I really like that. And then he talked about value add, right? As we mentioned, a lot of it's in the tech, so he doesn't need the U-Haul, the locks and things like that, because that doesn't add as much value as the tech. Now, again, later, if they've gotten all the tech and they've gotten everything frictionless exactly where they want it, then they can add some of that other stuff and kind of juice value more. So super interesting. It was fun chatting with Cliff. I'm super excited to watch them as they go through all this technology stuff and see what comes next. I'm really fascinated by it. So that's all we have for this time. We'll catch you next time in the left field. Thanks for hanging out in the left field with us today. If you are interested in becoming a left fielder, you can find us on the World Wide Web at www.leftfieldinvestor.com and click the subscribe button to join our community. If you enjoyed the podcast, please subscribe to the show on your podcast player so you don't miss an episode. If you really enjoyed the show, a review on Apple Podcasts or wherever you listen to podcasts would be appreciated.
This show is for entertainment purposes only. Nothing said on the show should be considered financial advice. Before making any decisions, consult a professional. This show is copyrighted by Passive Investing from Left Field and Left Field Investors. Written permissions must be granted before syndication or rebroadcasting.